So we're going back to our example, the Apple call of 280 before April 17th. Again, you know, Apple is trading right now at $280, and we have the right to buy Apple for $280 on or before April 17. So how much is the option worth? We already talked about it. It's worth nothing because it is out of the money. Apple is trading right now at 260, so that kind of doesn't make sense. However, if we look right now at the option price, we see that this option is priced at $1.20. Now, you already know this $1.20 is the so-called time value. So what happens with this $1.20? If you're trading call options and if you are a buyer, if you want to buy this option right now, again, as an option buyer, what do you expect Apple to do? Go up, go higher than 280. Otherwise, you wouldn't buy this option. So as a buyer, you pay $1.20 for this. As a seller, on the other hand, the seller gets the $1.20. It's a very simple transaction, right? It's like buying or selling a banana. So you get the idea. This is what trading is all about. All right, now let's talk about two possible scenarios. Let's say in scenario one, Apple shoots up, as you expected, to $290 by April 17th. So what does this mean? That when it goes up all the way, how much is the option worth right now? If you have the right to buy Apple at 280 and it is trading at 290 right now, how much is this option worth? $10. Exactly. So as a buyer, here's your profit. You would get the $10, the difference, but you remember you paid $1.20 for the option. So your profit would be $8.80. As a seller, it's the other way around. As a seller right now, you have to sell Apple at 280, but it is trading at 290. So you're losing $10 here, right? But earlier you got $1.20. So your loss is $8.80. Does this make sense? Of course, the money that the buyer makes is exactly the money that the seller has to lose. Does this make sense of who is making money when and where?